Alright everyone, welcome back for another episode of Carnivore Trades. My name is Aaron Basile, and this is going to be the first video of a new series of market educational videos and technical analysis sort of education that I hope to add to this channel. A lot of you guys have asked for some content like this, and I hope to be able to provide some more of it in the future. So if you guys like it, give me a like and a thumbs up, and we'll give you some more content down the road. But first video is going to be on head and shoulders patterns. I think this is an important one to do because I see a lot of new investors take head and shoulders patterns and they kind of get excited and they run with it. Now this pattern has a high degree of failure, but it can also be a very powerful reversal pattern, and when it's done right, it can make you a lot of money. However, this pattern has again a very high degree of failure, and over this video I'm going to show you which patterns you want to stay away from, why they fail, and which ones are valid and how to spot them. So without any further ado, let's get right into it. Now, before anyone asks, yes, this applies to inverse head and shoulders as well. So it doesn't matter any pattern I show you, if it's a bull flag, a bear flag, a head and shoulders, a wedge, whatever. If it works on the upside, it works on the downside, highs, lows, whatever. So yes, this applies to inverse head and shoulders patterns as well. So with that said, let's get right into it. Head and shoulders patterns, why do they fail? So generally there are three main reasons why these patterns fail. First reason is probably the least most common, but it's still very important, and that is the pattern is too easy to see, meaning that is a clear and obvious pattern. And we'll get into this a little bit more later, but essentially when you have a pattern that is very obvious, it tends to actually almost work in counteractively, so to say. For instance, a really clean-cut pattern is something that even an amateur investor can see, and the institutions and algos are programmed to recognize these patterns, and they will often bait retail investors into buying very clean looks on the chart just so that they can gobble up the shares and reverse the pattern another way. So sometimes the cleanest patterns are actually the ones that fail more often. But again, that's just the first reason. The other two reasons are actually much more important. So reason number two is that the larger time frame does not confirm. And what I mean by that is a lot of times someone will look at, they'll show me a pattern, oh, head and shoulders on the, on the daily chart or on the hourly or whatever, and I say, well, look at the weekly, you're right into support here, or on the monthly, you're right into support, or you're in an uptrend. And when you're not looking at the larger time frames, that's actually one of the main reasons why most patterns in general fail, is that traders are so focused on one pattern and they think that's it, but they don't focus on the bigger picture and they don't follow the overall trend. And then you have the third and final reason, which is that the pattern is often misdiagnosed as a continuation pattern, or the pattern does not occur at an extreme high. And I'll get into that a little bit more, but essentially what you need to know is that head and shoulders or an inverse head and shoulders are by nature reversal patterns. They are not continuation patterns. For instance, a bull flag or a bull wedge or something like that, a symmetrical triangle would be a continuation pattern. You have a sharp move up, then you have consolidation, and then a move higher. Head and shoulders is a reversal pattern. So you want to see it occur at an extreme high, or with the inverse head and shoulders, you want to see it occur at an extreme low with no support or resistance levels nearby, because that is significantly going to reduce the odds of the pattern playing out. But again, we'll get into this shortly. So with that said, let's get into some charts here so I can show you a few examples. So starting off here with my first reason number one, the chart pattern is way too easy to see. We are looking here at a chart of Peloton over the last year or so. Now you can clearly see, you don't even need to, I mean, it could be your first day learning technical analysis and you can see this clear chart pattern here. You have shoulder, head, and then right shoulder there, and it's very obvious on the weekly time frame as well. So it's so clean. I mean, this is one of the cleanest head and shoulders patterns you're going to ever see. The neckline is just barely ascending. I mean, it's almost a 90-degree angle, very close. It's very rare to see this. So this is a very clean and really pretty looking head and shoulders pattern. Why did this fail? Well, let's first start off here. You can see we came down here, we had the little bear flag and then breakdown. Nice flush there on volume. I believe there is news involved, but it doesn't really matter. But the reason why this thing failed is you can see what was it going into. You see this chop here, previous all-time high. Look at the volume. Excuse me, look at the volume here. You've got basically an all-time high in volume at this level. And what that tells you is that there's institutional money sitting between $80 and $90. Institutional money, hedge funds, investment banks, they have big money clients that have lots of shares in Peloton between $80 and $90. You see on the weekly chart, it's even more dramatic. Look at where, so look at, this is the volume here. I mean, you can't even see the volume on the weekly time frame before this $80 level. So that's how powerful the buying is here. So why would you want to short on this? And this is a beautiful pattern, don't get me wrong. You don't want to short this. There's lots of money sitting here. And not only that, right beneath that, you have this level of consolidation as well. You got these pivots here. And we look at all these levels of support. So for this to break down, it would take an absolute massacre. I mean, it would probably take the whole NASDAQ rolling over as well to get Peloton to push through these levels. There'd have to be some real panic selling going on and pretty much a broad-based sell-off. So when you see these patterns, yes, this is a clean pattern. Yes, you see it on the weekly and the daily time frame. But one of the things that I see most traders, one of the biggest mistakes they make is they never analyze volume. They always say, oh, this stock's breaking out or this stock's breaking down, and I look at well, there's no volume behind it, and then they find out a day or two later when they get the stock gets whipped in the other direction that they end up stopping out and losing money because they're not paying attention to the volume. This matters. That's clients of hedge funds and investment banks are going to want their portfolio managers to defend that level. They don't want to take a loss. I mean, I don't know about you, but I don't like losing. And if I have institutional money where I can push stocks, enough money to push stocks in the direction I want to, I'm going to do that. So when you see this happen, when you see this volume here, that's significantly decreasing the chances of this. Also, again, pattern so clean to see. When it's that clean, you know that amateur traders and newbie investors are going to be shorting on a breakdown. Institutions love that. They want to get this stock cheaper. They've been buying it this entire way. Look at the volume here. So if you're telling them they can get it for cheaper, of course they're gonna let you break it down and buy those shares. And then basically they just run it higher and everyone stops out and then it squeezes the shorts. So now with that said, a little bit on the side here, would you be able to short this at any point? Would I have a problem with it? Yeah, I never want you to short a breakdown of a Head and Shoulders because it's too risky. What you do is you look for pattern. So you see the breakdown, and then if you get some sideways consolidation and this doesn't close above the neckline, then you can go ahead and short it. If you get a bear flag, then I have no problem with it. But it's going to take a lot of consolidation to move through that kind of volume there. And it's not a terrible risk-reward trade because you know that your stop is just above, let's say, 96 or so, 95. Let's say you get in at 89 with a small position. I have no problem with that. Or you short the 20 moving average. I don't have a problem with that because that's a low risk reward. However, you want to see more consolidation. It's going to take a lot to get through this amount of volume. Also, look at the volume on the buy side. So the stock dumps, and then you see, look at the volume. Look at the shares that are being bought up. That's institutions, that's not retail, that's real, that's big money. So you can see these patterns fail, and again, close to support and blatantly obvious to anybody who has two eyes and knows the first thing about chart patterns. So whenever it's too easy of a layup or a slam dunk, it's generally probably too good to be true. So now with that said, I'd like to show you sort of a harder to see Head and Shoulders pattern and why those are a little bit better. So we're going to flip over to Apple here, and you can see here this little chop right here is actually a Head and Shoulders pattern. Yes, I know it's pretty ugly, it's not clean, but it's a Head and Shoulders pattern. You have your left shoulder, your head, and your right shoulder. Now what happened here? This one played out perfectly to target. You had a target of 145 to, we'll call it 129, And that played out pretty much perfectly. You went right down almost to the 200 moving average. So you see, it's the harder to see ones, the ones that, you know, require a trained eye, that are more likely to play out. The ones that are very easy to see, especially on bigger name equities like Apple or, you know, Amazon, or, you know, the S&P 500 or NASDAQ, those ones have a lot more eyes on them, and it's a lot harder, you know, it's a lot less likely for those to play out. And so another example of this is that of Bitcoin. You guys know I talked about Bitcoin and this head and shoulder pattern, but really there was not many people talking about it on the internet. Again, harder to see. So you have the shoulder, and then you have this sort of double head, and then a right shoulder. I actually refer to it as more of an MA pattern. So you have your MA right here, M, higher pivot, and then an A. But essentially it's the same thing. You have a double head for the head, but you have the shoulder and the right shoulder. No one's talking about that. What happens? It breaks down and hits target within 5 days. So that was a level I called out. I said, as soon as it breaks this, it's going to 30,000. I didn't think it was going to get there that fast, but nonetheless, shows you the power of these patterns when they actually play out. Now, one pattern that a lot of people are talking about is this big head and shoulders pattern on Bitcoin, which I think will fail because that's been circulating the internet like crazy. So far I've been proven right. We did test the lows 3 times now. We made this lower low, and we had nice volume on the reversal, and I do think Bitcoin is going to move higher here in the near term. Now, that doesn't change my opinion of it long term. I still think it's going to have to test 20,000, but that's irrelevant. We're talking about the head and shoulders. I think it fails. It's just too easy to see, and I've seen these types of things play out too many times. So now, another good example I want to talk about here, before we move on to the next topic, is GDX. So looking at GDX here, let me just put these trend lines up. You can see very clearly shoulder, head, right shoulder, and then you have a nice breakdown. And again, you can also see it on the weekly pattern very nicely as well. Same thing kind of as Peloton, really. You know, very clean on the weekly and daily pattern, time frames rather. And then, of course, this failed. Why? Why did that fail? Well, again, it was easy to see, but to move on to part 2, larger time frame, not confirming. Look at what you went into. You had a multi-year, so going back to 2013, pivot high, 2016, pivot high, and then 2019, pivot high, and you started hammering on it. Now you consolidated beneath it. You had the flush out from the pandemic, put in a low, and then you finally broke out. And then all this really did is back test this previous breakout and the 20 moving average. So I mean, you have the weekly and the daily time frames both putting in a really nice head and shoulders pattern, but look at where your support is. Now this is very strong support here. Look at these pivots. It took you almost a decade to break out of this level. So what makes you think you're just going to break right back down? So, and I saw people talking about this head and shoulders pattern on Twitter and all over the internet. Oh, GDX is going lower, this and that. But look at what you're going into. Again, larger time frame, not confirming. So this is something that, again, with volume, lack of volume analysis and lack of looking at the larger time frames are the 2 biggest reasons why most newer traders fail, and why a lot of traders fail, honestly. They don't look at the bigger time frame and they don't analyze volume. So GDX, another great example of why you need to look at the bigger time frames and why these head and shoulders patterns do fail. Now, some of you might be saying, well, you know, I saw the thumbnail there in the first slide you showed me as well. Wasn't that the S&P 500 in 2011? And you'd be absolutely correct. And you might also say, well, wasn't that a very easy to see pattern? And didn't that play out perfectly to target? You'd also be correct. So I'm going to explain why that pattern played out, but also it makes for a perfect segue into point number 3, which is that head and shoulders are not continuation patterns and they are reversal patterns. So simply put, yes, obviously this is a very easy to see head and shoulders pattern. It occurred on the S&P 500. We're looking at the SPY ETF right now, and this is going back to 2011. And actually, if I pull the chart back a little bit more, just bear with me 1 second here. All right, so you can see you have this nice run up and then head and shoulders reversal. Well, Why did this one play out where others failed? Again, so some of the reasons that I've listed should kind of give you a clue here. But look at what you were going into. Again, larger time frames. This is the 2007 pivot high, and then you came down into a bear market and you had all this chop between 145 and 130-ish on the SPY before the absolute panic sell. So there was, believe it or not, this is how support and resistance works. There's people still stuck. There's people still stuck long, believe it or not. Yes, there were. Stuck long at this area. And where do you think they're going to be sellers? Right in this area. 135, 130. Look at the volume uptick. As we make the first leg down, look at the volume uptick. That's real sellers. That's telling you there's real sellers in there. So you can see when a chart is in an extreme high and it is close to resistance or at an all-time high, for instance, these patterns have a lot more or a higher percentage of playing out. Now, later on in this year, I'm so glad that this happened this way, because later on in this year, we got actually just a few months later, whoops, as we go through here, just a few months later, we got a perfect example of a failed head and shoulders. Now, why did this one fail? Well, it's kind of obvious, honestly. So you have shoulder, head, shoulder. Ignore this trend line here. That's just from an old analysis. But really, here's your, shoulder, head, shoulder. You broke the neckline, you chopped around, and then big reversal, and then pretty much just never looked back. Ever. Why did that fail? Well, again, head and shoulders are reversal patterns. They're not continuation. Look where you came from. I mean, you went from 132 all the way to 110 in a week or 2 weeks. So a head and shoulder, you can't really reverse here because you're already going in that direction, right? So again, not a continuation pattern, it's a reversal pattern. This would be attempting to be continuation. This is reversal. This failed. This did not. So there you have some examples of why some head and shoulders patterns fail, which ones play out, and the reasons why. And really the reasons why are kind of the same as to why everything plays out. Volume, relative position to support and resistance, and larger time frames. Those are the main things you have to watch for. That should be a part of your trading arsenal and analysis every single day, every single night. So with that said, I'm going to let you guys go. I hope you enjoyed this analysis. I'm going to do a few more of them. Hopefully they won't be as long as this one. But regardless, hope you guys liked it, and we'll see you later on the chart.